Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, August the 13th, 2025. So let's have a look a little bit at this whole inflation data yesterday. We can see that, well, yesterday we heard from Stephen Miran, who, of course, is being nominated to be on the board of the Fed. And he said, and I have a quote here, there's zero macroeconomically significant evidence of price pressures from tariffs. So Stephen Miran, now we know he's a big Trump loyalist and is going to be on the Fed. Zero macroeconomically significant evidence of price pressures. And on the back of that, we also had Treasury Secretary Scott Bessent calling for a 50%, 50 basis points sort of cut at the September meeting. So not just one cut, but essentially a jumbo cut. So two, like equivalent to two cuts. So really the political pressure is piling on. And basically the market also was fairly dovish reaction yesterday. So just what I want to do here, just pull this from Bloomberg, is just a few charts actually looking at the inflation situation. And what's interesting to me is that the market essentially took from the data yesterday to say it was in line. Therefore, that's not going to stop the Fed from resisting the political pressure and cutting in September. And the key thing here is that the idea is that because of those employment numbers, which were revised very negatively on the 1st of August, so, a couple of weeks ago, that's going to give the Fed the cover, the necessary sort of intellectual justification or justification from the data to cut interest rates. But looking at the, so let's just go through, got 5 or 6 charts here, have a quick look at these of where the situation is in terms of what the CPI actually said. So this is the overall sort of breakdown here. You've got food, energy, core, and core services, of course. And core goods. And a lot of people are looking at the core goods to say, well, hey, most of the tariffs are going to be on the goods. And is that a problem? And it's difficult to see here. But what I just want to put in mind is that the basic point here is that, inflation obviously has come down since the bad old days of, 22, 23. But the thing is here is that it does seem in the last 3 or 4 months, as you can observe here, overall, it is overall sort of trending up a little bit. So you can't say that it's, completely vanquished, that it's down towards 2%. I mean, there's the Fed's target in theory is 2%. Now, has the Fed de facto abandoned their target? And they're essentially sort of, they won't admit this publicly, but they're essentially saying, hey, 2.5, 2 3/4, we don't want to risk the employment situation worsening. Therefore, let's cut. And we also don't have to deal with the orange man in the White House at that point and make their life a little bit less stressful. So what we're seeing here is that definitely the core services is ticking up. It's a little more difficult on this chart to see the subcomponents here with the core goods, and the core goods is just down here. So let's just have a quick look here. We've got the core goods. This is the contribution. So again, the core goods is like the stuff which is going to be tariff, not so much sort of service costs. And what we can see here is that core goods actually, generally has been trending down over the last couple of years. And actually there was a bit of disinflation, so negative price action, so to speak, on the goods. But what we can see is over the last 2, 3, 4 months here, it is creeping up. Now, you can be Scott Bessent or Trump or Stephen Miran and say, hey, this is nothing, this is at low levels. It's possible. I mean, that's one way of looking at it, to say this is not, to use Stephen Miran's words, macroeconomically significant. So the question here is that, one could say, yes, goods are getting a little more expensive. Inflation is ticking up in core goods. But if you're Stephen Miran and a Trump supporter, you could say that is not macroeconomically significant. And that's the question. That's the interesting question. So let's look at a couple of other things. And these are some of the sectors which, in theory, would be quite affected by sort of tariffs, because a lot of this stuff is imported, especially right from China. And we can see here that if you look at household furnishings and supplies like, furniture, this kind of stuff, you can see that definitely does seem to be ticking up. Apparel, which is, essentially clothing, that has been coming down. Is this just statistical noise, or is that ticking up as well? Recreation commodities looks as though it's ticking up. New cars, which is not really a tariff issue as such, because a lot of this stuff is prices, but we have the price of parts going up. New cars looks to be going up. So if you look at some of these sort of subcomponents and these little sectors, it's difficult. I mean, one could argue that these are not at sort of the highs of 2022, 23, but it is difficult to argue against what the chart seems to be telling us, which is that, hey, it looks as though prices are ticking up a little bit. Now, is that economically significant is another question. Now, the one which the Fed likes to look at, specifically Jerome Powell, this is the X services, but excluding shelter, so excluding the cost of rents and housing. And remember that Powell was very obsessed about this in 2022, 2023. This was really the main thing he was looking at as being significant. So presumably he's still looking at it. And again, a similar kind of situation. You can see here that, year over year, that does seem to be ticking up. And if you look month over month, it is a bit of a choppy number. But again, it doesn't seem to be, just steadily falling. So if we continue, what do we got next? If we continue, the next one to look at is the sticky prices. So this comes out of the Fed, the Atlanta Fed. They have a bunch of interesting sort of metrics, and this is the sticky price. So these are sort of goods and services which are difficult which are not very sort of flexible in the sense they tend to remain pretty much sticky where they are. And if you can actually look here, you can see that they have been going down. If you look at year over year or sort of annualized, but again, we're starting to see this sort of uptick. And really, the question is whether those sticky prices as well is starting to sort of plateau at a lower level and is starting to tick upwards, in back up towards 3 or so. And again, this time from the Bank of the Fed, the Cleveland Fed. This is the trimmed mean. So what this does, this takes out the outliers, the most extreme movements on the positive and negative side, and really tries to look at a core. And a lot of economists, a lot of people like to look at this as being a fairly pure measure of inflation. And again, similar kind of situation that obviously inflation has moderated over the last couple of years. But are we, again, you see on the right-hand side here, are we starting to get, the median and the trimmed mean sort of starting to tick up yet again? And, again, this whole sort of patterns reproducing itself. Now, what is interesting, and this is what Trump is talking about, is that definitely energy prices have gone down. So we know that a big part of what Trump is saying is, hey, I'm going to get the price of gas down, price of energy, price of gasoline, all this kind of stuff. And that did go down. And last month's CPI, the energy component, which in theory, the Fed says it can't control. Remember, the Fed likes to look at core, so excluding food and excluding energy. But nonetheless, it is true to say that the CPI excluding energy doesn't look that bad. And excluding energy, you could say that this is at a comfortable level. I mean, that's 3% up there. So it's definitely not at the Fed's target, but one could argue that the headline number is not too bad. And this is the kind of chart which, people like Trump and the administration are leaning on and say, hey, energy is, a big part of people's everyday costs. So you shouldn't exclude it. You can't exclude it. And if we take into consideration that energy costs have gone down, one could argue that inflation indeed is not such a huge drama. So let's cut because we don't want the employment situation to worsen. That is the kind of the logic. And again, and that logic comes on from, we look at the last jumbo cut, which was 50 basis points. And the Fed did that, if you remember, back, I think it was September of 2024. And this is one of the arguments of the Trump administration at the moment and saying, hey, guys, like if you look at the unemployment rate, that was ticking up back then. So, and we're now back at that level. So why don't we cut at least once, if not 50 basis points? And also, if you look at the unemployment rate in this so-called prime age, you can see here that we're getting back up to those levels. So that's sort of a little bit of the logic there, is basically to say, if the Fed could cut 50 basis points when the unemployment rate was over 4%, we're now ticking up over 4% unemployment rate. Why don't they cut again? And inflation is not too bad. Let's just put it that way. And then finally, one thing, just in talking about the employment market, you can look here at the wage costs. And so we see here full-time wage costs and part-time. Now you can see here that this is the year-over-year sort of average rise in wages, which of course has a big effect on inflation. And you can see that that's come down quite a lot. But the point is here that we're still not at the 1 or 2% annualized. We're still, in full-time, we're at about sort of 4% still, in part-time about 3%. So you can still see here that if you look at the cost of wages in terms of wage rises, on average, they're going up 3 to 4% every year. So therefore, that's not really comforting for the Fed, because that's indicating that, wage pressure is still sort of a fact. Anyway, so that's sort of looking at it. And so my takeaway looking at that, I think it's complex, just because, the market yesterday, let's see what the market said. Mr. Market's always right, after all. because we're not economists, we're here, to trade. And so let's just look at what the market is saying. The market basically now, and let's is saying that for September, it's a fully priced in 24.3 basis points. So that's 97% chance of a cut. So the market yesterday took this as not necessarily saying that inflation is vanquished and the foe has been slain, the dragon has been slain, but really the fact that they're saying, well, maybe this won't prevent the Fed from cutting, and keeping in mind, as I said, that the employment situation does seem to be weakening. It's almost like, well, good enough, close enough is good enough sort of situation. Now we can see here, as we can see that by the end of the year, we've got 3 cuts almost priced now, 2.9 cuts. So basically, I was saying that between November and oh, sorry, my mistake there. I was looking at January. So January we've got almost 3 cuts. So by December we've got 2.5 cuts. So 61 basis points. Now remember, for a long time, those of you who watched this video, I was saying that was often, it was like at 50 basis points, 45, 52, just hovering around 50 basis points, which equates to 2 cuts. And now you can see we're well above 61. And I'm just curious to see whether the incoming data confirms that, because if we get strong numbers at the next report and a lot of the subcomponents, and we get a strong sort of inflation number, I mean, that's going to be, I think, a little difficult to justify. And of course, just talking about the data we had yesterday, I think it was the new head of the BLS, the Bureau of Labor Statistics, essentially even floating the case of suspending data for a month or 2 or 3 to figure out what's going on. So the other issue here is that how closely will the market adhere to the data releases, like the efficacy or the accuracy, I should say, of the data. That's going to be an interesting sort of point. But if you see what the market reacted yesterday, so this is the on 1st of August, where the revisions to the payrolls number. So we see that huge repricing dovishly. Ever since then, this is for December pricing. It's hovered around about 60 basis points, so just over 2 cuts, up, down, up, down, up, down. And yesterday, this is what the reaction we got yesterday. So as you can see, we were just before the data, we were trading at about 56 basis points, and we're now at 62, but we did get down all the way to about 63 or so. So, a good sort of 3 or 4 or 5 basis points dovishly repriced. And the markets essentially said, hey, we think rate cuts are coming. So that's what the market's thinking. And we can look at that if we just go back and look at the SOFRs contracts, so the short term. And again, I just took this back to the day before we had the repricing, thanks to the data on the 1st of August. So this goes back to the 31st of July. And we can see that the live data is where we are now. This is implied yields. And you can see here that all across the SOFR curve, you see the yields have come down pretty significantly, especially if you look at this area at the end of this year, 2025, and going into the spring and sort of summer, shall we say, of 2026. We've seen here, we've had a repricing of, let's call it 1 cut, around about 25, 30 basis points. The market has all repriced, expecting lower yields. And if we now look at the terminal rate, we can see the terminal rate, which is essentially just where the market thinks the lowest point will be going ahead. We can see, looking into March of 2027, we're down at about, just over 3.05%. So let's call it 3%, which is about 133 basis points from now. Keep in mind that the effective Fed funds rate now is 4.33. So down to 3 is about 130, let's call it 135 basis points, which equates to, about 5.5 cuts or so. So the market is basically pricing in now in this cycle going into, 2027, basically about 18 months out, around about 5 cuts. So there it is. That's what the market's saying. Now, on the back of all that, of course, we've got the equity market loving it. So let's just go back and look at a few charts. We have volatility is down. So we're now at under 15 on the VIX. So that's going to be positive. But not only on the VIX, we also have volatility. If you look at gold, volatility is down. If we look at oil vol, you see oil volatility has fallen off. And if we look at the MOVE index, you can see the MOVE index, which is volatility of bonds, essentially. You can see here on the daily chart, look where the move is. So all in all, the market is quite relaxed across a broad range of assets. And this is being reflected in the equity. So I think we all know this chart. Look at all the moving averages. On the daily here, we've got the ES poking up to new all-time highs as we speak here in the morning at almost the 6,500. Nasdaq pretty happy as well. And then interestingly enough, yesterday, the Russell, which had been outperforming, had a huge move up of about 3% yesterday. So the Russell overall still hasn't reached its new all-time highs, as you can see. So it's still underperforming the, let's just draw this guy over here. It's still underperforming its cousins, the other indices, but really a strong sort of outperformance yesterday and a strong push up. Now, there's been like this is a very, very shorted index, and a lot of people are short sort of long Nasdaq, long ES, short the Russell. So there could be quite a lot of short covering here as well. So, everyone who's short the Russell maybe had to cover their shorts yesterday, but nonetheless, a situation where you have a reasonable economy, inflation is not bad. Companies still have a little bit of pricing power. So even with inflation and a bit of tariffs, they can still maybe push up their prices a little bit and get higher nominal earnings and income. It's not a bad situation. And also the small caps enjoying the lower yields potentially. And so, just interesting to see there. Yesterday we had the Mag 7 ETF up. And then if we look at the equal weights, also having a pretty strong day yesterday. So all in all, equities liking this little sort of mixture of a potentially, accommodative Fed, a Fed which is going to cut 25 or maybe even 50 basis points. Tariff-related inflation is not perfect, but it's not out of control. Employment situation maybe is weakening just a smidgen, but historically still pretty strong. That's quite a pleasant combination of factors for equities, and we're seeing that. Now, if you look at globally, well, let's look at Germany. You see, even over in Germany, the stock 600 up a little bit. If we look at the German index, again, not as strong as the US, but still doing okay. If we look at something like Australia, for example, I think almost all-time highs in Australian stocks. So that's doing very, very well. If we look at, let's say, the Nikkei, also doing very, very well at highs here. So the point is that global stocks are quite liking this mixture of a reasonable economic background. Tariff situation is seemingly coming to some sort of uneasy, messy compromise. And we also have potentially, central banks around the world being relatively accommodative, which is a nice mixture for equities. We shall see if it lasts. Now, obviously, the bonds. We can see here, for example, the short-term bonds here in the US, you can see here pushing up here. Is this a bull flag in the ZT? Looks as though that wants to go up. So we're seeing here the bond market in the US doing pretty well. And if you just look at the curve, the strong performance by the front end of the bonds there, that's steepening the curve. So we go to the 230s. We had a pretty strong bull steepener yesterday. And you can see here, look at this level here. We're at a very key level here, basically at the very top of the trading range. Look at all those moving averages pushing up. And you've got to say that this is looking as though there's room for further steepening. And, if you want to ask me the question, can this steepen further? I would have to say yes. Yes, ma'am. Yes, sir. You definitely can steepen up to over 2%. Now, will it take a bit of a breather? This is a pretty key point. Can this sort of come back a little bit? Yes, it can. But essentially at this point, you have maybe a Fed, which the market believes anyway, is at least going to be cutting once, twice, or thrice over the next 3 or 4 meetings. And combining with that, with the fact that the US deficit we saw yesterday is still going higher, they still need to issue a lot of bonds. And inflation, as we've been looking at, is still, let's call it a little sticky or a little bit above target. So that means that the pressure is always going to be on the long end of the curve, which is going to, relative to the front end, is going to push those yields up, which is going to steepen the curve. So any kind of pullback here, really you should be buying the steepener or going along in the steepener. Now, can you buy it here? Well, if you're a breakout trader, you can, but definitely this is interesting to watch. And we see that also 5s, 10s also steepening. If we look at 2s, 10s, not as much as the 2s, 30s, but still steepening. And if we look even at the 10s, 30s, so this is interesting. This is the 10s, 30s is almost like purely sort of risk premium at the long end of the curve. Even that's steepening a little bit. And of course, these lower yields, they are affecting the currency. So if we look here at the US dollar, you can see the US dollar, essentially the market again has voted and said, that CPI data was relatively, acceptable. And we also have some questions about the trust in the US system. Like you have people like the head of the BLS, now the Bureau of Labor Statistics, saying that maybe they're going to suspend data and we had Trump yesterday outrageously coming out and saying that he's going to sue Jerome Powell, head of the Federal Reserve, about overrun costs for the Fed building. So there's this whole sort of environment which is a longer term issue and a sort of a structural and a symbolic issue, but just a little more risk premium being priced into the US bonds maybe, and a little rotation, a small rotation away from the US dollar. Why not, in this environment with lower yields, maybe throw a few more sort of assets to the euro. So we see the US dollar here now looks as though it's heading downwards again, maybe to test down here at the 96, 97 level. You see these moving averages, the 20-day moving average flattening out. They had been turning up, but it looks as though they're being rejected here. And sort of flattening out a little bit as well. So this overall, the longer term trend still seems to be intact, and the momentum does still seem to be towards the downside for the US dollar. And that's being reflected in things like the euro. You see the euro now turning up again. If you look at the Swiss franc, you see the Swiss franc also continuing to show strength as the US dollar versus Swiss franc, so US dollar going down. And against the yen, not a lot happening there, but overall against a lot of the currencies, you see against the Aussie, for example, the Aussie sort of moving up against the US dollar, even despite the relatively dovish RBA from a couple of days ago. So overall, this risk-on tone is benefiting other currencies, and US dollar seems a little bit weak. So I'm not going to talk too much more. Just wanted to talk a little bit about oil. You see here oil going down. See oil pretty weak here. You see it's broken down. Remember, I was talking a lot about this need to hold these levels here. So it's broken down below all of the moving averages here. It's broken down, probably breaking stops or this support here. This does not look good. Even though the global economy seems to be okay, we are at the point of sort of an overproduction and surplus. And in fact, yesterday we got the API, so we got the private inventory data at 4:30 yesterday afternoon. That was a build in the crude of 1.5 million barrels that had been expected to be a small draw. So that's not a positive. And there's this general sort of sense that inventory levels are starting to build. And we had a report overnight from the IEA, which basically lowered their 2025 and 2026 demand growth forecast. So they have a forecast which forecast demand growth, and they basically revised that downwards. And they also said they expected to see, this is a quote, the market will be facing record supply glut next year. So glut, a surplus. So a record supply glut next year. So this symbolically not great. Obviously, OPEC came out with their own report, which is a little bit more optimistic and positive. But overall, we've got a situation where the global economy seems to be okay. But it does seem that there's a little bit too much production just to, for what the world needs at the moment, and increasingly so. And allied to that, of course, we do have this, this I don't know, how can I call it? Curious meeting between Trump and Putin coming up this Friday, where there might be some sort of quasi or pseudo deal arranged, so therefore less sanctions potentially on Russian oil. So all of this is not great for oil. And just technically now, I think probably the momentum sellers are starting to push this downwards. Anyone who's long here, if you're long at oil here, you're going to be stopped out. And suddenly all the longs are going to be more and more squeezed. We're going to start seeing a bit of a sort of a long liquidation here. So I think oil here, unless there's some geopolitical event, the easiest path of resistance here really is sort of towards the downside, maybe at least to $60. It could be some support down there because at $60 or in the late 50s, that becomes trickier for especially US producers to make a profit. And so they tend to sort of slow their production, which, in the medium term will actually cause a support for the oil price. But at the moment, it does seem like there could be a little bit more pain for oil towards the downside. Talking of which, we get the official oil numbers today from the US government, Department of Energy at 10:30, as always. And finally, today, we do get a Fed speaker, a voter. We get a few Fed speakers, but we also get Goolsbee, who is a voter. So interesting to see what he has to say. No doubt Trump will be furiously tweeting still. Scott Bessent from the Treasury, the obsequious yes man, will no doubt, here we go. just on right on time, 7:42. Scott Bessent suggests Fed's rate should be 175 basis points lower. Well, it's not so much different from the market because, as I say, if you look at the SOFR market, they're basically saying it's going to go down to 3%, the rate, and we're at 104.33 at the moment. So you could argue that Scott Bessent is saying 150 to 175. The market itself is pricing in about 150 basis points of cuts. So Scott Bessent actually just echoing what the market is saying. It's just the time frame. The market is saying it'll get there by early 2027, whereas I suppose Scott Bessent and Trump would like that to happen tomorrow morning. Oh, actually, hold on. Let's just quickly check. There's a bunch of headlines here from Bessent. Good data. Antoni is incredibly well qualified for the Bureau of Labor Statistics. I called for a shadow Fed chair, but don't think that's a good idea. Trump very open-minded on Fed chair. Oh, 10 or 11 people for the Fed. Private sector people for the Fed. Current Bessent wouldn't expect Stephen Mirren to say at the Fed past January. Okay. Right. Okay. And there's a headline here. You see OPEC Plus reshaped oil markets to spawn to cause a record glut. Yeah. The oil market not liking these negative headlines here. Percent again, rate cuts could start with 50 basis points in September. If data had been accurate, possible to have had Fed cuts earlier. Okay, so you get the picture. The picture here obviously is a lot of political pressure coming from the Treasury, coming from the White House. We get it. They want the Fed to cut. Okay, so we'll get a bit more information today. So there's the CPI data from yesterday. Let's have a quick recap. And it is interesting that actually some of the numbers did, in fact, sort of go down. If you look at, let's say, for example, the CPI month-over-month headline did actually go down, but year-over-year was still, above the Fed. But what we do have today, we do have the PPI, which is the producer price input, of course, which is important, and that also feeds into the core PCE. So expect after this, you'll get a lot of people on Twitter and economists crunching all the numbers, because that'll give us a much better read on the core PCE, which of course is the Fed's preferred gauge of inflation. So let's keep an eye out for that. It's going to be interesting if this comes in line or even a little lower than expected. The dollar will really fall quite a lot more, and the front end of the curve will rally, and no doubt gold will probably have a bit more of a rally as well, and stocks will like that as well. So let's keep an eye on the PPI. On the other hand, what would be quite interesting for me looking at it will be if the PPI kind of contradicts this notion that, inflation is not such a big issue. So let's keep an eye on this. Obviously, the key ones are the monthly numbers, excluding food and energy, is probably the most important one to be looking at. The market is expecting 0.2. So definitely pretty important to look at that for today. And we also have, no, sorry, my mistake. I thought that was the wrong day. Yeah, that's tomorrow. We are the 13th today. My bad. So that's tomorrow. Okay, you're right. Today we actually don't have much at all. Tomorrow actually will be interesting because we've got the PPI, initial jobless claims, and then some other stuff at the end of the week. Okay, guys, I'll leave it there. I've spoken for too long. Have a great day, and we'll keep this going tomorrow. Thank you.